There's a company that's increased its dividend every single year for 67 consecutive years, through recessions, through wars, through the dot-com crash, through 2008, through the pandemic. 67 years. That means if your grandfather bought this stock in 1957, he'd be getting paid more every year for nearly 7 decades straight. And yet, most investors have never heard of it because it's not sexy. It's not trending on Twitter. Nobody's making TikToks about it. You open your phone, you see people talking about the next AI stock, the next Tesla, the crypto that's going to moon. Everyone's chasing the home run. Meanwhile, there's an entire category of companies quietly depositing increasing amounts of cash into shareholder accounts every 3 months, year after year, decade after decade. They're called Dividend Aristocrats. And today, we're looking at 5 you can buy and genuinely hold forever. Not because they're exciting, but because they work. Let me tell you about my neighbor, David. He's 52, architect, makes good money, around $110,000 a year, but he's terrified. He came to me last month with a question. He said, I've got maybe 13 years left until retirement. My 401k is mostly in index funds. Should I be doing something different? I asked him a simple question. When you retire, do you want to sell pieces of your portfolio to pay bills, or do you want your portfolio to pay you? He stared at me. Nobody had ever framed it that way for him. His entire strategy was based on accumulation. He'd never thought about the distribution phase. This is the mistake most people make. They spend 30 years building a portfolio. Then at retirement, they're forced to sell shares during bad markets just to cover living expenses. Dividend Aristocrats solve this problem differently. They pay you to hold them, and they increase what they pay you every single year. But first, let's understand what a Dividend Aristocrat actually is, because there are very specific rules. Rule 1. The company must be in the S&P 500. So we're talking about large, established businesses, not speculative small caps. Rule 2. The company must have increased its dividend every year for at least 25 consecutive years, not maintained, increased. This is brutally hard to achieve. Out of 500 companies in the S&P 500, only 67 currently hold this status. That's about 13%. Think about what it takes to increase your dividend every year for 25 years straight. You need durable, competitive advantages, pricing power, disciplined management, strong cash flow. You can't fake this. You can't PR your way to aristocrat status. The cash has to be there year after year to send to shareholders. Now here's where the psychology gets interesting. Most investors today are obsessed with total return. They want the stock that goes up the most. They're chasing capital appreciation. But there's a different game being played by a smaller group of investors. They're building cash flow machines, portfolios that generate increasing income streams regardless of what the stock price does. Let me show you why this matters with simple math. Let's say you have $50,000 to invest today. You're 40 years old. You won't touch this money for 25 years. Option 1. You put it all in a growth stock that doubles every 7 years. At 65, you'd have around $400,000. Impressive. Option 2. You buy Dividend Aristocrats yielding 3% with 7% annual dividend growth. You reinvest every dividend. At 65, have around $380,000, slightly less. But here's the difference. With option 1, to generate $40,000 of annual income in retirement, you'd need to sell 10% of your portfolio every year. In a bear market, this is devastating. With option 2, your portfolio is now generating over $40,000 in annual dividends. You sell nothing. The cash just arrives in your account 4 times a year, and those dividends keep growing, even in retirement. So your income is increasing while your principal stays intact. You can pass the shares to your children. This is the wealth-building model nobody talks about because it's boring. It takes decades. There's no dopamine hit, but it actually works. Okay, let's get into our 5 picks. These aren't the highest yielding aristocrats. They're not the most exciting. They're the ones that combine reliability with growth potential for the next 20 to 30 years. Number 1. Johnson & Johnson, ticker symbol JNJ. This is the company I mentioned at the start. 67 consecutive years of dividend increases. Johnson & Johnson makes products you use without thinking. Band-Aids, Tylenol, Listerine. They also have a massive pharmaceutical division and medical device business. The current dividend yield is around 3%. Not spectacular, but here's what matters. Their 10-year dividend growth rate is about 6% annually. Let's do the math. You invest $10,000 today. Year 1, you receive $300 in dividends. That's 3% yield. Year 10, assuming 6% dividend growth, you're receiving about $510 annually on your original $10,000 investment. Your yield on cost is now 5.1%. Year 20, you're receiving around $915 annually. Your yield on cost is 9.1%. The stock is paying you nearly 10% per year on your original investment. This is the power of dividend growth that most people don't understand. The yield doesn't stay at 3%. It grows every single year against what you originally paid. Johnson & Johnson operates in healthcare, which is one of the most recession-resistant sectors. People need medicine whether the economy is booming or crashing. They also have pricing power. When you're sick, you don't negotiate the price of your medication. You pay what it costs. This translates to consistent cash flow. Number 2. Coca-Cola. Ticker KO 62 consecutive years of dividend increases. Warren Buffett's been holding this since 1988. Coca-Cola currently yields about 3.2%. Their dividend growth rate over the past decade is around 3 to 4% annually. You might think, who cares about Coca-Cola? Soda consumption is declining. People are health conscious now. This is surface-level thinking. Coca-Cola owns over 200 brands. Minute Maid, Dasani, Smartwater, Fairlife Milk, Costa Coffee. They're a beverage company, not just a soda company. More importantly, they operate in nearly every country on Earth. When emerging markets grow wealthier, Coca-Cola benefits. That's billions of potential new consumers. Here's why this matters for dividend growth. Coca-Cola has a $140 billion market cap, but operates in countries with a combined population of over 7 billion people. Even tiny increases in consumption per capita translate to massive revenue growth. And that revenue growth funds dividend increases. The psychological mistake people make with Coca-Cola is judging it based on American consumption trends. But America is only 4% of the world's population. Number 3. Procter & Gamble. Ticker PG. 68 consecutive years of dividend increases. The longest streak on our list. Procter & Gamble makes Tide, Pampers, Gillette, Crest, Bounty, Charmin. Products that people buy regardless of economic conditions. Current yield is about 2.4%. Not exciting, but their dividend growth rate has been around 5 to 6% annually. Here's what makes Procter & Gamble special. They have what's called share of wallet in consumer staples. When you walk into a store, you're buying their products whether you realize it or not. Let's say you spend $100 on household goods each month. Statistically, about $30 to $40 of that goes to Procter & Gamble brands. That's market dominance. The business model is simple. Make products people need to buy repeatedly. Maintain pricing power through brand loyalty. Convert that revenue to dividends. During the 2008 financial crisis, while banks were collapsing and tech stocks were getting destroyed, Procter & Gamble's revenue barely declined. People still bought toothpaste and diapers. This is what you're really buying. When you own Dividend Aristocrats, you're buying resilience, boring, predictable, increasing cash flow regardless of what the economy does. Number 4. McDonald's. Ticker MCD40. 8 consecutive years of dividend increases. The stock currently yields about 2.3%. McDonald's dividend growth rate over the past decade has been around 8% annually. This is where it gets interesting. Let's run the same math. $10,000 invested today. Year 1, you get $230 in dividends. Year 10, with 8% dividend growth, you're receiving about $497 annually. Your yield on cost is now 5%. Year 20, you're receiving over $1,070 annually on your original $10,000 investment. Your yield on cost is 10.7%. This is the compounding effect of high dividend growth. McDonald's might start with a modest yield, but patience turns it into a cash-generating machine. McDonald's isn't really a restaurant company. They're a real estate company that sells franchises. They own the land and buildings, Franchisees pay rent plus a percentage of sales. This model generates incredibly stable cash flow. Whether the economy is strong or weak, people eat at McDonald's, and franchisees pay rent. The psychological barrier with McDonald's is the same as Coca-Cola. People think it's a mature business with no growth, but they're expanding aggressively in developing countries. China and India alone represent nearly 3 billion people. McDonald's is still in early innings of penetration in these markets. That's decades of runway. Number 5. Realty income. Ticker O. This one's different. It's not in the Dividend Aristocrat Index because it's a REIT, not a standard corporation. But it deserves mention. Realty income has increased its dividend every year for 30 consecutive years. They pay monthly, not quarterly. They literally call themselves the monthly dividend company. Current yield is around 5.5%, significantly higher than our other picks. Dividend growth is slower, around 3 to 4% annually, but you're starting from a higher base. Realty Income owns over 13,000 properties, mostly retail, Walgreens, Dollar General, FedEx. They use triple net leases, meaning tenants pay taxes, insurance, and maintenance. The monthly dividend structure is powerful psychologically. Instead of waiting 90 days for payment, you get cash every 30 days. It feels like rental income from real estate without managing properties. Here's the math on a 50-50 portfolio. Let's say you split $20,000 between the first 4 stocks and Realty Income. $10,000 in JNJ, KO, PG and MCD combined gives you about 3% yield. That's $300 annually, or $75 quarterly. $10,000 in Realty Income gives you 5.5%. That's $550 annually, or about $46 every month. Total portfolio yield is 4.25%. That's $850 in year 1. On $20,000 invested. Plus, all 5 companies are growing their dividends. In 10 years, with average dividend growth of 5%, your annual income on that $20,000 is around $1,385. In 20 years, it's over $2,250, and you never sold a single share. The companies just kept sending you increasing amounts of cash. This is what financial independence actually looks like. Now let's address the real question nobody asks. Why don't more people invest this way? Why are they chasing growth stocks and crypto instead of building dividend machines? The answer is time perception. Dividend growth investing requires a 20 to 30-year horizon. Most people can't think that far ahead. They want results now. There's also social pressure. When your friends are bragging about their Nvidia gains or their Tesla returns, saying you own Johnson, and Johnson feels embarrassing. It's not exciting. But here's what nobody tells you. Those friends who are up 50% on Nvidia this year, most of them will eventually give it all back because they don't know when to sell. Meanwhile, your boring dividend aristocrats are depositing cash into your account every single quarter, regardless of what the stock price does. You never have to time anything. The long-term consequence of ignoring this strategy is reaching 60 years old with a portfolio you're afraid to touch, because selling means locking in losses during downturns. David, my neighbor, understood this after our conversation. He didn't abandon his index funds, but he started allocating 20% of new contributions to Dividend Aristocrats. His plan now is simple. By the time he retires, that 20% allocation will be generating enough quarterly income to cover his basic expenses. His index funds become the growth layer he never has to sell. This is the perspective shift. You don't have to choose between growth and income. You build both. The growth happens in index funds. The income happens through aristocrats. Here's what smart investors actually do differently. They think in cash flow, not just account balances. They ask, how much is my portfolio paying me? Not just what's my total return. They also understand that the best time to buy Dividend Aristocrats is when nobody wants them, when yields are high because prices are depressed. That's when future returns are highest. If you're in your 20s or 30s, you have time to let dividend growth do its magic. A 3% yield today becomes a 10% yield on your cost in 20 years. That's the game. If you're in your 40s or 50s, you should be transitioning toward income-producing assets now. Not at retirement, now. So the cash flow is established when you need it. The mistake is waiting until 65 to figure this out. By then, You've lost decades of compounding dividend growth. You're starting from scratch. So here's the calm, logical conclusion. These 5 Dividend Aristocrats won't make you rich overnight. They won't double in 6 months. They're not going to be mentioned on CNBC, but they'll do something more valuable. They'll send you increasing amounts of cash every year for as long as you own them, through recessions, through bull markets, through whatever comes next. You won't check your portfolio every day because there's nothing to check. The dividends just arrive. Predictable, growing, compounding. 20 years from now, when your friends are panicking about sequence of returns risk and trying to figure out safe withdrawal rates, you'll just be collecting your dividends. That's the difference between gambling and investing. Gambling requires you to be right about timing. Investing just requires you to be patient. If this approach makes sense to you, consider subscribing. We focus on long-term wealth building, not hype. No get-rich-quick schemes, just clarity on how money actually works. And remember, this isn't financial advice. These are observations about how certain companies have performed historically. Your situation is unique. Do your own research. Consult professionals if needed. But at least now you understand there's a different game you can play. One where time is your ally, not your enemy. One where patience gets rewarded. One where boring actually wins.